Hello, everyone. This is Andrew Berman from National Mortgage Professional. Thank you so much for joining us for another Mortgage Leadership Outlook, where we've been meeting us starting with 2020 with some of the biggest, brightest, and most influential executives in the mortgage business. And today is just such a great honor to have Keith Lind, who's Executive Chair and Vice President of Acra Lending. Keith, thank you so much for joining us today.
Thank you for having me.
So listen, I mean, there's a lot of things I wanted to talk to you about. I mean, it's interesting, actually. The let's call it the year that you guys have had. From actually, obviously the pause on non-QM, the everything we were dealing with from our operation, and then you guys actually wrap up with a rebrand, which I want to get into because it's a lot more than a rebrand. But first, let's start off back when Keith actually was a little boy and said, "I want to grow up to be a mortgage banker." Right? Does that happen?
Not exactly, but that sort of is what happened. Yes.
So when you were growing up, when you decided to go to school, what actually what was your dream? We'll talk a little bit about where you went from there, but initially, but when you were thinking about your career, what was that career looking like?
Yeah, I always said I wanted to get into finance, right? Finance is such a broad, right? It's such a broad business, right? And I was at Purdue University. I was at spring break and I was at a leadership conference, and afterwards they had said that there were some recruiters, and this was in Mexico, and I was one of the few that stepped up and put my name down and said I'd be interested, because they did mention the job was in New York. After some tough interviews and a lot of chasing and following up, I was able to land an interview at Bear Stearns, where I ended up getting my first job out of college, and sort of the rest is history. But had a great started there in 2001, up until they were acquired by JP Morgan. But it was an incredible experience. Worked with a lot of very intelligent, smart people. Learned the structured products business really from front to back. Started off on the financial analytics desk for the first 2 years while I was at Bear Stearns. And then I went to the trading desk where I was structuring deals and purchasing whole loans. And then after that, I went to strictly trading bonds. They really, the education, and sort of, it was tough, right? You worked a lot of hours, but all of it paid off. And I think I don't think, it's unfortunate Bear Stearns isn't around anymore, but I think the Fast Desk is, which is where I started, was one of the best educational platforms, for anyone entering, the bond side of Wall Street, where you really, they had great leaders teaching. And I really learned a lot.
So, and what do you think actually, from those days, from being on the other side of the business, not being on the origination side of the business, what did you learn actually from those that helps you with Acra, that helps you actually put this organization together?
I think anytime you're a trader, right, you need to understand risk. And I think if there's anything I took out of being a bond trader, it's understanding risk, liquidity, counterparties, right? So, and I think that's something that, it's unfortunate, but I was able to put to work right away when we bought the company in February and COVID hit a month later. I think the firm, the company, the management team, I think we did a very good job managing risk, securing the balance sheet. And I think, if there's one thing I would say that you learn by being a sell-side trader is understanding risk and being able to make quick decisions, right? Making decisive decisions. So I think that's what I took out of my previous life, being on the sell side and bringing that here. I think that's probably the biggest piece I was able to bring here. Now, going from that side to an operating company, there's a lot of stuff I still need to learn, which I'm doing. But there's definitely a lot of overlaps as well.
So what's an area that you feel actually you need to like kind of learn that you feel like you're not at the high level that you want to be at?
The transition, again, coming to an operating company, it's when you're a trader, you sit there and you're trading bonds all day, right? And you're maybe dealing with some salespeople. When I stepped in here, I stepped into 260 employees, right? And when COVID hit, which was unfortunate, we had to go from 260 to 160, and now we're already back to, I think, above 260. So it's people skills, right? I would say is the biggest thing. I think it's leadership, right? And that's not something that you're going to be exposed to, that head count, right? And the problems that you encounter, and empowering your managers and your leaders within the firm, right? And that's something that I completely encourage, right? And making sure there's open lines of communication, right? And people can raise concerns and be able to communicate and talk to their managers or myself. So it's a big portion of that is people, right? Dealing with people and leading those people.
So, and was there actually a point actually when like from here you're at Bear Stearns, and went to RBS, but like when was the point that you actually said, so being actually in the C-suite, being actually an executive for a mortgage banker is something actually that you wanted to see in your career?
Yeah, I mean, I don't think it happened. After Bear Stearns, RBS, then I went to Brevin Howard, which was a fabulous experience for 2 years. And then in 2017, I went to HBS. And I think what happened was it was just this continual grind, tighter in spreads. There wasn't a lot of opportunities as a trader in 16, 17, 18, 19. And there wasn't much to do at HBS, unfortunately. I fully appreciate the senior management team at HBS. Listening to the opportunities that I thought would be beneficial, right? Looking at in the non-QM sector, and they supported it, and we spent a lot of time looking at, what those opportunities looked like, what the risk was, what the reward was, and eventually, we found Citadel, which is now Acra. And they empowered myself and the rest of the deal team to make this, to make this come to fruition. So, listen, I think it was a process. It wasn't one day I woke up and said I want to do this, but I thought when the opportunity presented itself, that was the next step, right? I thought, I had spent enough time on the sell side, and I think coming to run an operating company, which I think has a tremendous growth opportunity, I just felt like that was the right time.
So was there ever a time actually during the transition, like, so here everything is falling apart actually March 2020, where you said, what did I do? Like, was there ever a point where you had actually I regret, but oh crap, what did I get myself into?
Yeah, I mean, listen, I think my first thought was, is this really happening again? Because I went through the crisis, right? The housing crisis at Bear Stearns. And these were supposed to be like once in your career events. And I'm like, is this really happening again? I don't, I knew it was going to be a long road ahead. But I knew we did it, to my earlier point, I knew we did a really good job managing the balance sheet and the risk and putting ourselves in a great position to come out of this stronger and better than maybe our competition, right? So when I thought we could gain market share and be really a leader moving forward. And the 5 months we had off, the amount we accomplished, was really staggering. We added $700 million of warehouse partnerships. Morgan Stanley, Credit Suisse, Goldman Sachs, and Barclays, to name a few. Next Bank of California as well. I walked in, we had $200 million of warehouse capacity. And we just closed our last facility, so we're north of 900 million now. We've made major improvements in technology on the servicing side and the operating side, right, to make things more efficient, to really help out the operation side. And I think that's one thing that lacks in the mortgage space. There is definitely, the mortgage space in general is behind the times in technology, and it's something we noticed and something that we're definitely making strides to fix. And then also human capital, right? Making hires of, with people that have superior experience, that believe in the vision that myself and the rest of the management team do. An example is Jeff Lemieux, who we hired to build out our correspondent division. He was at Cerberus, GMAC. He's been in the industry for a long time. We just hired a new Bernice Gonzalez, our new head of HR. And again, just two people, but we are. I think we've honed in the way we're analyzing and looking at candidates that want to join here and want to succeed with us. So the 5 months off, yeah, I mean, I knew it was going to be a long road, but that was okay. And I think, I could sort of see the light at the end of the tunnel now, which is rewarding. We're about 70 to 75% of where we were pre-COVID. Oh, wow. We rolled out a new product in the Jumbo Prime program, which is taking off very well. So I'm excited, right? Yeah, but to your point, yeah, was I concerned? I was definitely concerned. I was concerned more about the industry and borrowers, right? And the people we made loans to. But I think, there's something to be said for how much better the underwriting and compliance is today than pre-housing crisis in 2009 and 10. So, I mean, what do you feel actually led to? Because from what I understand, like non-QM loans from most lenders I talked to have held up during this time. So, what do you think actually, has caused actually, because listen, I mean, in March, when March was happening, and all of a sudden non-QM lenders were having difficulties, I was like, well, these are many cases business owners, and business owners are going to be the ones actually, hit first. So why do you feel actually that non-QM has still been performing pretty well, during this time?
Take a step back to, when COVID hit, right, and it got really bad. That was a liquidity crisis. That wasn't non-QM loans were going bad. That was there's no cash, and people don't want to put cash to work, right? And everyone was waiting for this big opportunity to buy loans at 20 cents on the dollar like they did during the housing crisis, right? That never came to fruition. And I think there was so much money on the sidelines waiting for this great opportunity in the RMBS space. And the RMBS space isn't that big because, if you look at the mortgage market, right, the 11 trillion mortgage market, I believe, is where we're at today. So much of that is agencies, right? And they felt their own pain too, right? A lot of them thought they were potentially going out of business, right? So I think, again, I alluded to some of the points: strong underwriting, a tighter credit box than what, previously, back towards a housing crisis. But also, the Fed did a good job keeping rates low. Home prices did well. People wanted to buy homes. So there's a big demand for homes. So I think all of that's helped. And, we look at we look at the forbearance numbers in our servicing portfolio. And I think a lot of that, that's up to our investors. We're a servicer. We originate the loan and then sell it.
Yeah.
So our investors made the decision on what to do on forbearance. And I'm sure there's a fair amount of borrowers that took the free option and said, give me forbearance. I know we did a small securitization. It was about 110 loans in June. We didn't want to sell the loans, but we wanted to, manage risk correctly. We thought the loans were worth more than where they were trading. So we did that securitization, and people asked for forbearance, but we made them prove a financial hardship. And I think of the 110 loans, only one person could prove that they needed forbearance. So I think that's a good example of I think non-QM performed very well, right? And I think over time, a lot of these forbearances will roll off and these people will stay current. But even if they were, if there's going to be situations where people are forced to liquidate, their home is going to be worth more probably today than when they got the loan.
Yeah, 100%. So, all right. So during this whole time, you guys are in the background. So COVID's happening. You guys are preparing a rebrand. Which is like, I mean, I hate even calling it a rebrand because it's not even a rebrand. It's like you've basically kind of just kind of remodeled the entire company. So talk to us a little bit about what the major difference is from Citadel to Acra lending, because it's more than just a pretty logo now.
Yeah, I think, listen, there's a couple of points that I would hit on, right? I think, when we came in,
I'm not sure the previous management team spent a lot of time on the branding. It was a business. They built a great business, but I don't think the previous management team wasn't into logos and getting and really spending a lot of money in marketing. Yeah. So from that standpoint, I think number one was there is a Citadel in Chicago, Ken Griffin, right? That the company would get confused with. So so I thought clearing that up was important. I thought a fresh look, right? And then what we did was when we got here, and even prior to closing on the company, we got a lot of broker feedback and customer feedback on things that we could do better, right? And I think part of that was going to help with a rebrand, right? And getting a new fresh name out, a new leadership style, right? A new approach to customers, right? I think some of the feedback that we got wasn't so great. It was Citadel tends to over-condition loans. Citadel is the lender of last resort. So my goal was to change all of that, right? And want to work with brokers, right? And figure out how can we get deals done without, I think maybe historically it was a no, right? Without trying to figure out a solution. Now we want to figure out a solution for everybody, right? But it's a culmination of a lot of pieces, right? But I think us coming out and it's a new leadership vision across the senior management team, not just myself. It's a new culture that we're building, right? And we thought a rebrand would really be the icing on the cake to get all this driven in the right direction.
So, what is ACCRA? Like, what is actually where did you guys come up with the name ACCRA?
It was someone on the deal team came up with it. We were trying to ACCRA's and actually it is a fortress just like Citadel. So staying within those boundaries is what we were trying to do. But we love the way it came out. I think the reception from everybody has been very positive. So not a big story to that at all.
Yeah, that's great. So and I mean, from an employee standpoint, but from people actually that are that were working at Citadel, like what were the changes that they felt? Because from what I understand, it's also been like a cultural change, within the organization. Besides certain policies and procedures changing and different people coming in place. Like what is the difference that someone feels going to work at ACCRA versus when they were going to work at Citadel?
Yeah, I mean, listen, I can't really speak to the past, right? All I could do was come in here and sort of look at what we had and the way the managers and the leadership team were doing their day-to-day. And it was too siloed, right? Everyone was protecting, all the managers were protecting their little businesses, and no one was communicating. So when I came in, I just let everyone know that we're going to have an open forum. Ideas are going to be shared. The managers aren't going to protect. They're going to empower people around them, right? And that's the way we're gonna build the new franchise. And it's been super beneficial. And listen, it's not that the previous way was wrong and this way is right, right? This is just I'm bringing in my leadership style. I think it's and listen, not everyone. I don't think everyone was a fan of my approach, and that's okay, right? But I think a majority have been. I think the managers, the senior management team, really likes the patterns and the success that they've been seeing. You don't change culture in a week, or Rome wasn't built in a day. So this is going to take some time, right? And some people, I don't know, right? Some people might not like it, and I'll do my best to work with them. But I can tell you, a high percentage like the new change of where we're headed, and the approach and putting the customer first. Right, and making sure at the end of the day, this is a great customer experience, because that's my goal, right? If you have a great customer experience with employees that want to come to work every day, the franchises, the company is going to do well.
Yeah, makes perfect sense. Listen, I always say, happy borrower, happy originator, happy borrower. They all work together. The originator's happy, the borrowers are going to be happy. So, listen, if you can talk to us a little bit about what you see actually in the future of non-QM. Like what opportunities are there for you guys as a major player, and also what opportunities are there for the originators that are out there offering the non-QM products on the street?
Listen, I think it's a huge opportunity, right? And we'll see what happens with QM. A lot of rules are being changed around how non-QM is going to be treated moving forward. I don't tend to get caught up in all of that. I know the business that we have now is nascent. There's a lot of opportunity moving forward, for not just us, for all of our competition. I want everyone to do well, right? There is a big opportunity here. It's going to take a lot of originators to make that happen. I think COVID's made a lot more difficult for some of the smaller guys, right? It takes a lot more capital now than it did pre-COVID, but that's okay. I think people will probably figure that out, or there's going to be consolidation, and some of the bigger guys will get bigger. But I think over the next couple of years, non-QM is going to become more streamlined and more liquid and more efficient, just like the jumbo prime market, right? And I think, I think one of the biggest positives I've taken out of this is we've got more investor calls from people that didn't care about non-QM pre-COVID, but care about it now because they saw how well it performed through COVID. Yeah. So I think that's just one of the stepping stones for us getting to, for non-QM to get to the next level and be efficient, just like the jumbo prime market.
So what about originators that are out in the street? Like, what do you think the opportunities for them to get involved in non-QM? Like, whether it's the kind of clients or a strategy, is it, do you think actually that they should be, focusing their business on it, or just kind of like, when it's conventional form fallout?
Listen, it depends on their expertise and how much money they want to invest in these businesses. Non-QM is it's a hands-on underwriting, right? You get a lot. Every situation is different than the next, right? And I laugh. I talk to our underwriters, our senior underwriters, and these guys are like professional puzzle builders, because you got to find out all the moving pieces, and if you don't, that could be problematic, right? And that could cause problems. So we have fabulous underwriters, an awesome operations team. They communicate great. So I think that's on an operator by operator basis, whether they want to step into this space. Some may just say, I'll take the low hanging fruit agency business. But I do think when rates rise and there's so much focus from the brokers right now focusing on the agency product, but when rates go up a little bit, the non-QM market's going to have a strong tailwind, and I think there's a big opportunity coming.
Yeah. So and how are the secondary markets reacting, to non-QM loans today?
Very well. I mean, I was just looking at a securitization that printed last week. So we're back to pre-COVID tights, even tighter on the senior bond, which is the biggest part of the capital structure. And I think the biggest problem right now is that there's a technical that there's not enough loans to buy, right? Wow. Everyone's so focused on the agency business. I think we're one of us and two or three other people are one of the only people originating and selling loans to people. A lot of the bigger originators, right, all that origination is spoken for. They're either securitizing it themselves, maybe the PE firm that owns the company is taking the supply, the hedge fund that has its hand or an investment in that company is taking the supply. So listen, I think any investor out there wishes there was more loan origination to be bought, for sure.
So what is there a strategic advantage to having that, where you're both doing the origination and the servicing? Like what is the advantage to an originator?
Yeah.
So forget about actually whether it's more profitable or less risk or more risk. The people watching this, they don't care. They care about from an origination standpoint, what is their benefit, from doing business with a company like you guys, that's creating the products, being innovative in the product creation, but also actually, servicing that loan.
Yeah, I mean, we're always talking to our capital partners that we sell loans to, and they're extremely complimentary over the fact of how good we are as a servicer, number one, right? And I think when you're selling loans to someone, or in our case, we're a smaller servicer, and they know if there's an issue or they have a question about something, and they call ACCRA, or the servicing side of our business is called Citadel Servicing still. Yeah. They know who's going to pick up the phone, and they know they're going to get a response right away. When you're dealing with the bigger shops like SPS and just using them as an example, nothing, no harm there. right? These guys are bigger, right? And the turn times on responses and attention to detail, unless you're there, I know it is from us. And our capital partners really appreciate that and they like it. So, we are one of the only originators that sell our loan servicing retained. And we've had very few complaints. In the beginning, when we're dealing with a new capital partner, sometimes people sort of, signing up a new servicer could be, somewhat timely. It does take time. So there's some logistical hurdles, when someone starts buying our loans. But I think, once that's ironed out, people are happy that we're servicing their loans. They think we do a very good job. And one thing I'll tell you, the servicing business is a profitable business, right? For us, I think I'll give you an example. When COVID hit, we took our headcount from 260 to 160. And for 5 months, we were able to basically stay cash flow neutral for those 5 months, retaining 160 people because of our servicing platform.
Wow.
So when we were originally looking, when I was at HBS, looking to make this purchase, that was one of the reasons why we really liked Citadel over any of the other competitors we were talking to, because we knew the value of the servicing platform, right? If it's done correctly. And we knew Dan and Kyle built it correctly. So we were happy to have it, and it's valuable.
So, and I'm just curious, like you're talking about the headcount, as far as the employees, are they back physically in offices, or are most of them working remotely?
Yeah, most are remote. I think 85% are remote. The 15%, because we are a servicer and we handle payments and accounting, some of those people have to be in, and then most of the senior management team comes in.
Interesting. So that could potentially be a cost savings for you guys.
Possibly in the future, yeah.
Yeah.
That's right.
Productivity. How did you find productivity as people hunker down in their home offices and basements?
So I think we put in very good guardrails about managing that risk and getting feedback on turn times and underwriting or processing or operations. So I don't think I think the jury's out whether we're more efficient working from home or from in the office. But I can tell you the performance is on par with where we were pre-COVID, and I think we're happy with that. And I think as we improve our technology, that's something over the next couple of months as we're implementing our new LOS system and some other systems, because technology is going to be a driver for us moving forward, right? We are going to make that spend. We think it's worth it, and we think it'll pay off. And then we'll be able to better understand, where we were pre-COVID and where we are now.
And maybe make a more predictable experience, in NonQM, which is basically, when I talk to a lot of originators out there, that's one of the things that they actually that they have a problem with. When they're dealing with conforming, they know actually what the loan looks like and what loans smell like. That's going to get approved and not get approved. NonQM, they feel like they don't have that level of predictability from what'll get approved, what won't get, and how long it will take. So, do you think actually that technology will bring about a little more predictability in the business?
Yeah, I'll give you an example. We just signed up with a technology company that reads bank statements, right? Now, it takes, for one of our underwriters, depending on how many pages the bank statements are, let's say it's a year and it's 120 pages of bank statements, to go through and figure everything out. This new technology does it in 10 to 15 minutes, right? So that's an example of something that we've invested in to help streamline the underwriting process. And then again, like I said, we're implementing a new LOS system. And I think, NonQM, there's a communication process because it's a more complicated loan, but we're turning loans in 30 to 40 days, right? The problem is our brokers are very busy with a lot of loans. So if we're asking for a condition to be cleared, they might not focus on that because they're focusing on 10 other deals. So that's my point I said earlier. When the agency market cools down a little bit and rates are up, I think that's the tailwind that we're going to see because people are going to realize that we can close a loan in 30 to 40 days efficiently and consistently. And it'll get the broker's attention to say, you know what, let me focus on NonQM a little more than I was.
Cool. Very cool, man. So listen, I want to wrap up with talk a little bit about your new Jumbo Prime. Talk to us a little bit about, what led to the decision to roll out the new Jumbo Prime product?
Well, I'm not sure there was one decision. It was a collective thought process, but it was something that I've seen coming from the sell side. And every bank I worked at had a jumbo conduit. So I spent a lot of time looking at the economics. What would it cost to build it out here? What are the margins? What are the risks? And do we think this is something we could be competitive at? And when I looked at all pieces, all three, four, five of those questions, I was able to check the box, right? So we partnered with Goldman Sachs to start off. We're talking to JP Morgan and Morgan Stanley potentially as well. But we're going to have the ability to balance sheet this ourselves. But Goldman's been great, and they've been helpful in getting us up and going. And I could tell you, we're submitting more loans than I thought 3 weeks into this, a lot more than I thought, which I'm super happy about. The next question is we just got to make sure we have the underwriters and the operations to back it up, which I believe we do. But that's a common problem across the whole industry. But listen, it's a $500 billion market, right? So it's tenfold of non-QM probably, and I think we have one of the best operations platforms in the private lending space. So this was a product that made a lot of sense, and we're happy we made that decision.
So you see any other future opportunities for product innovation?
Yeah, we are. We just spent the last 2 months really putting pen to paper and looking at the fix and flip business. So we were close to hiring an operator. It didn't pan out, but we're speaking to a few others as we speak. So I hope by midsummer, we will be launching a fix and flip product. And then from there, there's other products. I'm not going to speak to them now. I haven't done enough work, but from my past life and speaking to our capital partners, there's products out there that people want us to originate. They trust us. They really like the way we underwrite. So we'll definitely be launching more products than just jumbo prime and fix and flip here in the next year or two.
Fantastic. Super excited to hear about it. I mean, how you guys dealt actually with the shutdown of non-QM, came out strong, have a new brand, got some great product innovation, which is something actually I think that was Citadel was always known for. It's having actually great product innovation. Good actually management, good sales support, and great product innovation. Sounds like actually you've took that legacy, made a couple of tweaks to kind of upgrade it to make a better experience for the borrowers. I know better experience for the brokers. Change little cultural changes inside to make sure all employees go to work and they're super happy and excited about the future, as I know I am. So thank you so much for joining us, Keith. I really, really appreciate it.
Thank you very much for the opportunity.
All right. And thank you so much for joining us for another Mortgage Leadership Outlook, where we go live every Wednesday, 1 o'clock Pacific, 4 o'clock East Coast time, with the greatest leaders in the mortgage business. So really, really excited. Next week, we are going to have Phil Treadwell, who is going to be joining us. We're going to go dig into a little bit of his career and also talk about the new app called Clubhouse that everyone's going crazy about. So very, very excited. Thank you for joining us. Have a great day and a great 2021.